Okay, I'd like to welcome everyone to the New York Investment Roundtable monthly podcast for December 2022 entitled The G in ESG is the Key. I'm Robert Akeson of the Riverside Management Group, the moderator. And I think, as you all know, ESG has emerged as a topic of increasing global significance. So on behalf of the roundtable, I'm very pleased to welcome a true leader in this space, Jasper van Brakel, CEO of RSF Social Finance. And allow me to introduce Jasper. As CEO of RS Social Finance, Jasper sees firsthand the energy that mission-aligned catalytic capital sparks. He guides RSF in revolutionizing how people relate to and work with money, leading a talented team that develops innovative giving, investing, and lending programs to address the significant social, environmental, and economic challenges of our time. Now, prior to joining RSF in March of 2018, Jasper was a partner at Newpart Capital, a private equity firm for impact-driven companies. He serves as an operating partner in Armonia, an impact investor and regenerative field builder, where he initiated collaborative partnerships and provided strategic leadership to support several portfolio companies, both as an advisor and as a board member. Born in the Netherlands, Jasper worked for 14 years with the Welita Group, advancing from sales positions in Germany to leading global strategy, branding, and marketing initiatives. He moved to the US in 2008 to lead Welita North America as president and CEO in New York, a position that he held for 7 years. As chair and interim CEO at Welita's Dutch and Belgium subsidiaries from 2013 to 2014, Jasper restructured the company and positioned it for growth while maintaining the culture of the venerable natural, organic, and biodynamic consumer product company. Jasper is a graduate of Harvard's Business School's General Management program. He also holds a master's degree in economics from the Erasmus University, Rotterdam. He chairs the board of Gaia Herbs in Brevard, North Carolina, serves on the board of directors of Teton Waters Ranch in Denver, and sits on the advisory board of Flock, an accelerator focused on regenerative natural food. Jasper lives in San Rafael, California, with his wife, Marique, and their 4 children. Before we begin, I do want to acknowledge our sponsors and thank them, of course. And they include, and you can see them up on the screen right here, Alston Bird, Baker Tilly, Deloitte, Bloomberg, New Mountain Capital, Grant Thornton, and our not-for-profit sponsors, who include Kaya and Fordham University. I also want to call to your attention Jasper's contact information. Okay, so Britt, I think we have that up on the screen there. Okay, thank you very much. Terrific. So, Jasper, let's get to it. I think an appropriate place to begin is to make the following statement and get your reaction to it. Some might say that ESG is taking criticisms from all sides lately, all sides. What's your take on the value and utility of ESG? And why don't you speak for a moment to some of those criticisms, if you would?
Thank you, Robert. So appreciate you and the group having me today, and I'm really excited to talk about this topic. So ESG, it's been rightfully come under a lot of criticism lately because, first of all, there's a lot of greenwashing going on with some of the ratings agencies, at least, just doing a poor job of providing ESG ratings. But also, there are plenty of examples of public companies that are rated really highly in ESG, that kind of go against common sense, right? Big oil companies being rated as excellent in ESG, tech companies that may fall short on the G, right? With a single person basically calling all the shots and still getting really high ESG ratings. So there's a lot of criticism, and I get that, and I think it's important to acknowledge that. So, but let me talk for a moment about what the difference is between ESG and impact investing, because there's a lot of, those are the words that are out there.
Yes.
And they have a different meaning, right? So ESG takes on environmental, social, and governance aspects when evaluating investments that are usually focused on maximizing financial return, right? So the goal is to maximize financial return, and you look at other aspects that will help you make better investment decisions as you maximize for financial return for the shareholders. Now, impact investing says, yeah, financial returns are important, but it's not the only thing. We're also looking for outcomes that are in the kind of environmental as well as social realms. So impact investing has a goal to balance several impact metrics in addition to financial metrics. And that's how it's different from ESG.
Okay. So you've said governance is the most powerful element of ESG. Why do you say that?
Yeah. So the G in ESG, right? The governance, it's the least talked about element in ESG. And yet, if we want different environmental and social outcomes, we got to address the G. We have to address the governance in a company. And my basic tenet is that business can be a force for good, right? There's a lot of trash talking about the business world around, it being extractive and business being a leading cause of climate change, of social injustice, of income inequality, etc. And the point I want to make is that business can also be a part of the solution. Business has to be part of the solution.
How?
It's the only
How?
way, right? And exactly. So the way that we're going to do that is by addressing the G, by addressing governance. So it's not only about what companies do and how they do it, but it's also about who makes decisions and how are decisions being made. So, why is it the most powerful element? If we want different outcomes, we have to address the incentives. And if we want to address the incentives, we have to address how decisions are made and who makes decisions. And in a traditional board setting, in a traditional company, decisions are basically made by the shareholders, right? So governance is inextricably linked to ownership. And what I'm saying is, and what I would like to talk about today is, how can we disentangle those two? How can we disentangle the governance rights from the ownership rights? And there are plenty of examples that can be done. I know that initially that may sound like a romantic, crazy idea, but I guarantee you it's not. It's a very interesting and innovative way in which a company can still make really good money, can still return capital back to shareholders, but really take a stakeholder approach. So the focusing on the G in ESG is a way for us to dip our toe in the water when it comes to stakeholder capitalism. And
just as a point of clarification,
sure.
could you describe or identify what the range of stakeholders might be in any one given situation?
Yeah. So the way that we've seen this done by companies globally is that a company would identify their stakeholders. So it depends on the company. It could be, Bosch, the German company,
yes,
is an example of a company that's run and owned this way, that has had tremendous longevity and profitability as well. So for them, it's about shareholders, right? That's one stakeholder. It's about employees. It's also about suppliers. It might also be about clients or customers. It might be about other stakeholders that a company identifies, but usually it's between those 3 and 4.
Okay. Okay. And by the way, before we go forward, I just want to remind the audience, and forgive me for not pointing this out sooner, but the audience has an ability to provide Jasper with questions. So look at the lower right-hand corner. If you have any questions, just type them in directly to me or to Jasper, and I'm happy to put them in front of Jasper. So as we're talking, Jasper, a little bit more about stakeholder capitalism, why isn't the concept of stakeholder capitalism as described by people like Larry Fink and Jamie Dimon addressing what you just said? Why isn't it?
Yeah, that's a great one. So the Business Roundtable and other groups have commented on this, and what I would say is what they're basically, the point that they're making is, can we make incremental improvements and make people feel like they're heard while still 100% being focused on maximizing shareholder returns, and not including stakeholders in the decision making or in the governance, but by listening to stakeholders and still optimizing for only for financial returns for the shareholders. So I would argue that's not stakeholder capitalism. That is still shareholder capitalism, while providing a nod to various stakeholders. And so this really goes to what I said in the beginning about the difference between ESG and impact investing. And what we're advocating is, if we want different outcomes, we have to look at this in a different way, and we have to look at decision making and at fiduciary duty in a different way. It's great to see that they're talking about stakeholder capitalism, but it's different to actually share the power with other stakeholders, rather than saying you're going to listen to other people while still hoarding all the power.
Yes. And I think as we net out what you're saying, you're basically calling for changing the fundamental structure of corporate governance. I mean, it's really nothing short of that. And I would ask you, if first of all, to confirm that, and secondly, to put on the table what needs to change. Yeah.
So the answer to your question is yes. I'm calling for a fundamental overhaul of what fiduciary duty means, and this goes back to early 70s, the basic tenet that if people focus on maximizing their self-interest, the outcome for the collective is going to be the best, right? And capitalism has brought us a lot. So I'm not, a capitalism bashing, making a capitalism bashing argument. What I'm saying is that if we shift governance from only being focused on maximizing shareholder returns to being broader, and that is a fundamental overhaul, we're going to start to see different outcomes. And we need that, right? We're in a climate emergency. We're seeing, social and environmental issues really rising to the top of every boardroom, and failing to find solutions for that, I think is that's going to be a real issue in terms of company attracting the right talent, attracting the right capital, and actually surviving, as companies and maybe even as a species. So what needs to change in order to address that? So again, disentangling the ownership from the governance. I'll give an example, because this may sound, really complex and theoretical. So what the companies that do this, and again, Bosch is an example, Rolex is an example,
Yes.
Novo Nordisk is an example, and then there's a whole slew of much smaller private companies that have done this. So they put the voting rights of their shares into some vehicle that can be a perpetual trust, called a perpetual purpose trust, that has trustees that have a fiduciary duty to act in the best interest of the purpose of the company, of the mission of the company. It could also be that the voting rights are concentrated in what's called a golden share. So there's one share that holds all of the voting rights, and that's held, by a foundation or by a trust or by some organization that is that is focused on the long-term survival and the long-term sustainability of the company. And then you have preferred non-voting shares, or it could be any class of, as long as it's non-voting shares that are held by equity investors. Could be public investors, could be, private investors. And they get compensated, of course, for the risk that they run, and that can be in the form of some, capped return or some dividend. What you oftentimes see in these kinds of examples, especially in private companies, is that investors put in equity that behaves almost like debt, right? So it generates maybe a high single-digit dividend, and then after a number of years, there's an option to take money off the table and to exit. But because the voting rights are concentrated in a place where the goal is to protect the purpose and to protect the mission of the company in perpetuity, and an exit with a 10x or 20x or 30x return is unlikely. So the return to shareholders is there, but usually you don't see the type of unicorn exits that you might see in other industries and also in other governance models. So, when you're saying fundamental structure of governance needs to shift, I'm saying absolutely. And there are examples of companies that are doing this successfully and that can grow, that can provide liquidity to investors, to founders, that can attract new capital, and that serve a broad array of stakeholders. I also, Robert, I want to just squeeze something in here that a question I get a lot. So people ask me, so are you advocating for ESOPs? Are you telling us that, instead of the shareholders, the power and the ownership should all be with the employees? And the answer is no, that's not what I'm advocating for, because shifting the power and the ownership from one group to another just shifts the dynamics, but it doesn't fundamentally change the governance, right? It shifts it from one group to the other. And what I'm advocating for is a broad stakeholder governance and not a stakeholder representation necessarily, which we know, in democracy and in other areas of society, that can work actually as a laming factor, not as a factor that speeds things up and that leads to better outcomes. So I'm not advocating for ESOPs. I'm also not advocating for people to elect board members that are then going to represent one stakeholder group and fight everybody else, right? It's about disentangling the ownership from the governance.
Okay. And Jasper, on that note, we have a very interesting question from the audience. So let me see if I can convey it here. Can this restructuring be implemented at a company level in a competitive market, or does an impact optimizer need to be a dominant actor in its market? In a competitive market, wouldn't an impact optimizer be at a disadvantage when competing with a profit optimizer for competing for capital?
So
I think I got that right.
Yeah, so let me, it's a really great question. So a couple of elements here. A competitive company, company in a competitive market, which I would say arguably every single company is, right? We're all in a competitive environment. I would say it depends in what kind of market you're in. So if you're competing in a B2B or B2C market, then focusing on environmental and social outcomes, as long as that can be translated into brand advantages and into talent advantages, can actually be incredibly helpful in attracting consumers and attracting talent. If you're talking about attracting capital, then the question is, what is that capital interested in, right? Is the capital only looking to maximize its own returns? Or is the capital looking for, some balance between risk, return, and impact? And I think the audience member, if the audience member is focused on, is a company that is competing for capital that's only interested in financial return going to be as competitive? The answer is no. I think we got to be honest about that. So this type of companies, I think will provide, and they provide competitive returns, but maybe not the highest returns, because they're willing to make some trade-off in the interest of either risk reduction or long-term survival and profitability of the company. However, I would say, the examples I quoted, they clarify that these companies are incredibly competitive in what they do, and that makes them competitive in the capital markets as well.
Yes. So Jasper, just maybe to tie this up a little bit more.
Sure.
The models of governance, okay? What should we be looking at in terms of governance models going forward? What makes sense? Because you also referenced something, and I suppose there are many out in the audience, like myself, who were around during the 80s and 90s when, particularly here in the United States, a lot of work went into, let's say, upgrading the corporate governance process. Right. Yep. Before that, the governance model in the United States, I won't speak for other countries, but certainly in the United States, was very restrictive. And the SEC, FINRA, or the predecessor organization of FINRA, et cetera, all embraced the idea of democratization. And so what would these models look like?
Yeah. So, first of all, let me say that the models that really provide.
And if I'm sorry, not to cut, yeah, but if I may say something, I think one of the issues back then was the managerial capitalism, right? The idea that the managers, who also may own some shares but aren't the predominant owners of the company, basically had the ability to determine the direction the company was taking. And back in the day, people used to vote. We used to say they voted with their feet. Okay, in other words, if they didn't like the direction management was taking or the outcomes produced by management, they could simply sell their shares or they could buy more shares. Yeah. And the regulators determined that wasn't necessarily the only option that should be available to shareholders. They should have some impact through the corporate governance process. So how does what you're describing square with all that?
Yep. So legislation is always behind, right? By definition, things are being legislated either because, multiple times issues have come up. It's never proactive. And
yes,
so, I'm not advocating for necessarily for first changing the law. What I'm saying is private companies, as well as public companies, but let me focus on private companies for this part of the conversation.
Please.
They can, with their stakeholders, with their owners, with their management, they can create these kinds of stakeholder governance models under current legislation. It's not impossible, right? It's not an excuse. Legislation is broad enough to allow for this. So two things that stakeholder governance models do. One is self-governance. So it puts the steering wheel in the hands of the company itself, basically. So again, two examples that are often used are a perpetual purpose trust. People are interested in understanding exactly what that looks like. I encourage you to Google it. You'll find all kinds of articles about it.
Yes.
Term sheets, etc. So perpetual purpose trust, that is a trust that will be around infinitely, and that is beholden to the purpose of the company. The second one is golden shares. So you concentrate all of the voting shares on one share. You can still issue shares, but they won't come with the typical voting rights. And then you put the voting rights in the hands of some governing body that represents stakeholders, and that's focused on the long-term survival of the company. And so the first is self-governance. The second is that profits serve the purpose. So what that means is these companies aren't becoming not-for-profits. So this is it's oftentimes misunderstood, right? So you put your voting rights maybe in a not-for-profit foundation or in a trust. That doesn't mean that the company is becoming not-for-profit, right? It's still a for-profit business, but the profits serve the purpose. That means some portion of it goes to shareholders. You define a waterfall. So, maybe your shareholders get an 8% dividend, and then they have another, I don't know, up to 10% upside if profits are really strong. Then some percentage of profits could go to other stakeholders, employees, vendors, supply chain partners, etc. And of course, part of it is reinvested in the company. So the profits serve the purpose and all of its stakeholders. And the way to organize for that is to not compete between stakeholders, but to collaborate. And the art is to create an environment and also a governance model where it's not employees against shareholders, but it's how do you do that collaboratively. And there are plenty of examples in which in which companies do this really successfully and are able to build a model that serves all stakeholders long term in a company that's really competitive in the marketplace.
Interesting. And it brings to mind, I think, a company that everyone on the call is familiar with, and that is Patagonia. Would you say the new Patagonia structure follows one of these models?
It does and it doesn't. So let me pull that apart. So where the new Patagonia model does not follow what I'm saying is the philanthropic element. So,
okay.
The Chouinard family, they gave away all of their shares, right?
Yes.
And that's not what I'm saying anybody should do. I mean, it's great. It's very generous. And, to do this, to have this philanthropic.
But that's not the model you're suggesting.
It's not the model. It's not the model I'm
suggesting. If they want to do it, that's fine. But if that's not.
Exactly. Where it does fit the model that I'm suggesting is that they put the voting rights of the company in a trust, in a perpetual purpose trust, exactly the way I described before.
Right.
Where it does not necessarily fit what I'm advocating, again, is they're saying that all of the profits in the company are going to go to a foundation that's going to support climate change, mitigating initiatives. Again, fantastic. Yes. That's great. That's what they want to do. What I'm saying is the profits of the company should go or should be shared between all of the stakeholders. And in the case of Patagonia, the Chouinard family has said, our primary stakeholder is climate. It's the environment. Great. That's how they define it. So they're saying our profits are going to go there. And, but this goes back to your initial question about who are the stakeholders, right? And, planet Earth, you can define planet Earth as your primary stakeholder if you so choose. It's the deep end of the pool. It's really interesting to see it. And I think it'll do very well for Patagonia in terms of continuing to attract consumers that are willing to pay a premium and continuing to attract talent. Obviously, they don't need to attract capital at this point.
Okay. So Jasper, short of a dramatic conversion like that, okay, what other governance strategies can bring us closer to stakeholder governance?
Yeah. So one really important step, I think, is the whole B Corps movement. And I know, again, there's criticism there that it can be, greenwashing as well. It's just a label, etc. But the entire B Corp or benefit corporation movement and also accreditation really invites a company and its management and its board, its owners, to think broader than just shareholder returns. And for those in the audience that are familiar with it, public benefit corporations are an important step in this direction. So a public benefit corporation basically forces board members, directors to think not only about shareholder returns, but also about other factors, other elements in terms of social and environmental benefits. It's a good step. And I think we can take it even one step further. What other governance strategies would be helpful here is for boards to ask themselves, who do we serve, right? Who other than shareholders do we serve? And how can we include that view into the decisions that we make as a board? And the same goes for the CEO of a company.
Okay, so how will stakeholder governance models like the ones that you've mentioned attract capital?
Yeah. So,
and by the way, and
yeah.
I know I don't need to tell you this, it's one thing if our frame of reference is a very volatile market or an environment that is, let's say, not particularly promising for growth. How would you attract capital?
Yeah. So there's the examples that I've worked on also with RSF Social Finance, and we're primarily a debt fund, right? So we primarily provide debt so that founders can be bought out or to do some leveraged buyouts with these structures. We do a whole lot of other things, but this is one of the things we do. So this can be a really interesting proposition for debt providers to buy out existing shareholders and to get a return on your debt there. The other type of capital that I've seen being attracted to these types of deals is high net worth individuals, family offices, and your typical long-term holding strategy firms that are interested in a long-term, relatively low risk, dividend type return on an investment. This is not your typical venture deal, right? Although there are examples of companies that do this out the gate, right? Startups that fund themselves this way is usually a company that converts when it's really stable, profitable, growing nicely, and founders want to exit. And again, the typical structures for a conversion to this type of governance include some form of debt, some long-term, more dividend-focused equity, and then typically a balloon at the end. So it's either, you agree to put the money in for 10 years, and then there's some mechanism by which the equity holders can exit and get some return on their investment. That's a function of enterprise value. Okay.
And Jasper, I know, or I shouldn't say I know, I'll pose it as a question. ERISA rules and regulations, do they pose any special challenge to what you're describing? This type of capitalism, this approach to corporate governance?
So it doesn't. ERISA does pose a challenge to ESOP-owned companies, right? Because the trustees of an ESOP are they have a fiduciary duty to maximize the returns to their constituents, which is in this case the employees. So if there's, say, a hostile takeover bid that the employees may not want, but they have a fiduciary duty to vote in favor of it by way of their trustee, because it maximizes the return to the shareholders. So with a perpetual purpose trust, there are no ERISA issues. There are several law firms that have figured this out, also in the United States, with conversions to these types of alternative or mission first type ownership and governance models.
Okay. So how do you see governance's traditional role as risk mitigation in the context of these shareholder governance models?
Yeah, so governance, obviously it has to do a lot with risk mitigation and with making sure that capital is deployed in such a way that it's in the best interest of the shareholders, right? That's the way traditionally it's set up. That does not go away, Robert. It's really important to emphasize that what I'm suggesting is not anti-shareholders. It's not anti-capitalist. It's an evolving way of looking at capitalism that's more inclusive, that really has the potential to transform capitalism and transform the economy. So how to look at risk mitigation? There's a huge role for boards and for this type of governance to make sure that risks are mitigated. The universe for which they look at risk mitigation is broader, though. It's not only the shareholders. It may actually include the climate, right? It may actually include employees. It may include other elements, other stakeholders for which you're looking to mitigate risk, which indirectly or directly contribute to lowering the risk profile for the overall company and for the return to all stakeholders. So that role of risk mitigant is still key.
Several times during our conversation today, Jasper, you've referenced, I think you've used the term climate emergency. Let me ask you this. Would you say, to what degree would you say there is uniformity in the view that we are actually experiencing a climate emergency? And I know that this topic is not specific to climate emergencies, but you have used it as an example. So I'm just curious, to what extent do you see the climate of opinion, no pun intended, being such that people would agree that we are in fact in a climate emergency, or other such, let's say, imperatives?
So I don't.
And how important is that in this?
So regardless of whether people adopt the science behind it, I don't believe there's a single boardroom anywhere in which the impact of climate change or the impact of changing climate patterns isn't a factor. So this is something that every single board, every single investor, every single operator needs to look at. Whether it's out here in California with wildfires or with floods or extreme drought, climate, the climate is shifting. There's no doubt about that, and that changes the risk profile of pretty much every investment and pretty much every business. So whether we call it a climate emergency, which I am convinced we are in, or whether, which is probably more broadly supported, we call it climate risks that we're seeing. I think it's key. It's key to recognize that, and it's really important that as a business community and as investment community, I think we acknowledge that. We look at what the risks are, but we also look at what the opportunities are. And this goes back to my initial point: business can be a force for good. So we can take a step back and look at, okay, so what's happening? Where are the solutions, and how do we fund the entrepreneurs and the companies that are providing the solutions? And what are the governance models that fit the type of work that they're doing, providing the solutions that are going to help us get out of the mess that we're in?
Jasper, as that question rolled off my tongue, it dawned on me that as I gave your introduction, I noted the fact that you began in the Netherlands and you're now in California. So you went from an environment, from a country, the Netherlands, which has been tremendously threatened by the sea, in fact, and to a location now, California, which is threatened by fire in a tremendous sort of way. So I guess you firsthand have seen the devastating impact or the potential for devastation that climate change can bring on society. And it's interesting. Again, I've not been to the Netherlands, but my sense is that the country really stood up, acknowledged the challenge, and was able to stand up and basically come up with a strategy that you've executed on, or that they've executed on successfully. And one can only hope that we can say the same of California at some point, right? Because I know California's been ravaged by tremendous climate-related issues. So any thoughts on that?
Yeah, it's interesting that you bring this up, and I don't think there's a single region on the planet that's immune to what's happening. But those are two good examples. Netherlands, which is predominantly below sea level, so that's a threat, right? The dikes break, and everything floods. This is what that gentleman at HBSC right said about Miami. Well, that's where the Netherlands is at if the dikes break. So and it has been for a long time, right? Let me be clear, that's not driven by the last couple of decades in terms of climate change. The big flood happened in '53 in the Netherlands. But so what I've seen being really successful in the case of the Netherlands is public-private partnerships, where it's how do we link arms, how do we collaborate to fix something that we all agree needs to be fixed, and that can't be government alone. You need the private sector for that, and you need a way to collaborate rather than just to compete against each other if you want to fix those really large, or mitigate those really large risks, societal risks that we have. And I think there's, let me be diplomatic there. I think there's a lot of potential across the globe, and certainly in the United States, for these types of collaborative approaches, where it's not about how do I get more out of it for myself, but how do we create a structure in which, of course, as a company, we gain from this, or as an investor, we make money off of it, but it contributes to something that's much bigger than this.
And I think that makes a lot of sense. Absolutely. And I just want to add that I'm taking this call from Southwest Florida, which was the site recently, as we all know, of a devastating storm.
Exactly.
And it's amazing to see firsthand what Mother Nature can do. So yes, I think this is your insights are very timely here.
Appreciate it.
Yeah, and I think most importantly, given what you've described, okay, and your reasoning behind it, what would it take, Jasper? What would it take to spark, I'll use the term revolution, okay, a revolution what would it take to spark the revolution in governance I think that you're advocating here?
Yeah. So we need more companies to convert to this type of governance and ownership. And what that requires is it's actually not so much a change in the law, right? And as I said, that's going to be slow. It's not going to be ideal. It's going to be a compromise. We all know. I mean, that it really shows where we're at if we would lean into democratic decision making. So that's not what I'm asking for or advocating for. It's more companies converting to a mission-first structure. It's more boardrooms asking themselves the question, how do we optimize rather than maximize? How do we optimize for all stakeholders? Who are the stakeholders that we're serving here? Who are the stakeholders in this business? Let's have a conversation with them, right? And those are first steps. The B Corp movement. So can this company I invested in, or can this company I'm running become a B Corp? Could it be a public benefit corporation, which expands the fiduciary duty from just being shareholder focused to being broader? That's what it would take. And this whole notion of capitalism being able to be inclusive rather than only extractive, right? To be competitive in the market, but collaborative when it comes to solving big societal issues. We're not going to solve climate change by competing, right? Competing against what? The climate, the government, like that's not going to fix it. We're going to need these types of partnerships between companies and between stakeholders if we're going to solve those issues and going to create, the type of planet that we want our children and grandchildren to thrive on. So, what I'm hoping for and asking for is, did I lose you, Bob? At least I lost the picture here. Britt, did we lose Bob?
Yeah, he seems to have dropped off.
Okay.
I'm sure he'll call right back in, Jasper. Just keep going. Don't worry about it. I'm
Sure.
He'll
Yeah. Sure. So more companies moving to these mission-first business structures. And again, I encourage the audience to look up Perpetual Purpose Trust, or a good resource is also Steward Ownership by a nonprofit called Purpose. They have a really great website with a lot of resources on it. Also, legal resources around how exactly this is structured, how it works, what examples are of companies that are structured in this way. I wrote an article for Fast Company about it. So if anybody's interested, just Google my name and the G in ESG. You'll find some more resources around this. But really, the next step is for companies and for investors to tease what it might look like to shift from only being shareholder focused to really having a stakeholder focus in the governance and in the fiduciary duty of a company. I'm wondering at this point whether there are any additional questions in the audience. I can see the Q&A here, so feel free to put your question in the Q&A and happy to respond to it. I think we covered most of the questions that Bob had in advance of our conversation. So, open to any questions from the audience. And Britt, if you're getting questions in the chat, please let me know.
I will do.
Thank you.
Is there any messages that you think people should take away from this topic, Jasper, that you would want to sort of summarize with while we wait and see if Bob reappears?
Thanks. So the key message, I think, is if we want different environmental and social outcomes as investors, as board members, as operators and companies, we have to look at the G, and whatever change we look at making there, some of the deep end of the pool, if you will, changes that can be made is by sharing the governance with other stakeholders. But a board can also, without doing that, initially, can start looking at who are the stakeholders that we're trying to serve, and if we want different outcomes for the climate and socially, then what do we need to change in our governance to make sure that we get that? What are the incentives that we can set that will lead to different outcomes? That's really the takeaway message. We're not going to get different environmental and social outcomes if we don't address the G.
And are there any impediments in your mind that are the biggest ones that need to be overcome to make that happen?
Well, I think the biggest one is the expectation of wealth owners to have, your J curve type of financial returns, and that's the main issue. So this is not for the type of capital that is looking to maximize returns at the cost of whoever else, right? This is the type of investor and the type of wealth owner that is invested in or that's interested in making decent market rate returns, and is also interested in creating a better world.